Private credit. It's a term that's been making the headlines and moving the markets, with many claiming that it could be the trigger for the next global financial crisis. And yet, few have properly explained what private credit is, why it's been causing so much market volatility, and how such a small segment of the credit market could trigger a financial meltdown. And that's why today we're going to tell you everything you need to know about private credit in simple terms. My name is Nick, and you're watching Coin Bureau Finance. First things first, I am not a financial advisor, and nothing in this video should be considered financial or investment advice. It's educational content intended to inform you about private credit. And if that's the kind of content you enjoy, then smash that like button. And if this is the kind of content you want to get more of, then subscribe to the channel and ping that notification bell. Now, let's start with what private credit is. In short, private credit is any kind of lending that's done without a bank. For example, suppose I lent you $20. That would technically be private credit. Of course, the kind of private credit that everyone is talking about isn't the small hypothetical loan I just mentioned. It's about a much larger, much more complex, and much more integrated part of the global financial system. Here's a better example. Imagine you run a small business, like a car dealership, and you need a loan of, say, $2 million. You go to the bank, but they won't give you a loan because, say, your business is too new. So, instead, you come to me. I give you a $2 million loan, and it is collateralized by the cars that you own, meaning that if you fail to repay, I can take your cars and then sell them to get my money back. You accept my offer, and I give you $2 million, and that's the end of it, right? Well, not exactly. After I give you the $2 million loan, I then sell that loan to a pension fund that's looking to earn a high yield on their idle capital. And that means that the pension fund owns your debt, and the 10 to 15% interest rate you pay on the loan will go to them. I just got a small profit from selling the loan to them. Now, picture this. If a storm hits your city and destroys all your cars, meaning that the collateral back in the loan I gave you is worth nothing. You try to come to me again for another loan, but I can't give it to you because you have no more collateral. The bank won't lend to you either, and you have no insurance. So you file for bankruptcy, and the value of the loan held by the pension fund goes to zero. But wait, it gets worse. Remember how I gave you a $2 million loan? Well, it wasn't really my money. I borrowed it from a regional bank, and I still owe the bank $2 million. I could have used the money I got from selling your loan to the pension fund to pay back my loan, but instead, I lent that money out again to someone who couldn't repay me, and now I'm going to have to also file for bankruptcy. And this means that the value of the loan the bank gave to me also goes to zero, and the result is all of the headlines that you see. Systemically important financial institutions like banks and pension funds losing money because of private credit. In theory, it's no big deal. Only $4 million was lost there. In practice, however, people start asking questions. How many other loans like this are there out there? More importantly, banks and other lenders start asking, if I lend money to one of these private credit guys, am I sure I'll get my money back? Now, these questions lead people to start losing trust in financial institutions. Meanwhile, the banks and pension funds stop giving money to entities in private credit. The outcome is more debt defaults, less trust, and less lending, a negative feedback loop. Next thing you know, the financial system is frozen and a financial crisis has started. But let's back up a bit. How did we get here? And the answer can be found in the example I gave you earlier, specifically the part where you go to the bank for a $2 million loan, but they don't give it to you. You see, after the 2008 financial crisis, regulations were introduced to restrict banks from lending to high-risk clients, such as small businesses. But obviously, these small businesses still need to borrow. Many players in the financial system quickly realized that there were many ways they could make a lot of money from these dynamics. They could lend out some of their idle capital to these high-risk clients to earn a huge interest rate. They could borrow money from banks at a low interest rate and then lend it out at a higher interest rate, and they could of course keep the difference, or they could just issue the loan and sell it to someone else. A recent report by Morgan Stanley notes that the size of the private credit market is estimated to be around $3 trillion. Now, for context, that's 10 times larger than it was in 2009. Naturally, most of the private credit market is concentrated in the largest private credit companies, including Apollo Global Management, Blackstone, Ares Management, and KKR, which we'll come back to a bit later. First, you need to understand the two double-edged swords of private credit: complexity and opacity. Private credit loans tend to be incredibly complex. On the one hand, this can be a good thing because complex loans can protect lenders from losing money. On the other hand, this can be a bad thing because it makes it hard for third parties to get a sense of the risks associated with these loans. As for opacity, it can be a good thing, particularly as it relates to mark-to-market losses. And this is where our earlier example comes in handy. Recall how all your cars were destroyed by a storm? Well, consider a scenario where you were able to get a loan from me or from the bank to buy new cars. In this scenario, the loans sold to the pension fund would still have value because you'd still be able to pay them back. This is a perfect example of how mark-to-market can come in handy. Under normal circumstances, your loan to the pension fund would be considered cooked the moment your car lot got wrecked. But thanks to the dynamics of private credit, there's basically wiggle room for you to figure something out so you can continue paying your loan to the pension fund and they don't have to write it off as a loss. As you can imagine, this subtle dynamic is very valuable to many players in the financial system, because it means they don't have to declare a loss right away when there's an issue with one of the loans that they hold. Instead, they can wait and hope that the issue is resolved soon, and the outcome is fewer losses and larger profits, which in turn means more clients and higher stock prices if they're publicly traded. But it's easy to see how this can be a bad thing. The fact that entities playing around in private credit don't have to declare a loss on a loan until things get bad typically means nobody finds out about issues with these loans until they've gotten, well, bad. Not only that, but the fact that private credit is relatively unregulated means it's hard to figure out who is doing the lending and who is doing the borrowing. Again, you only find out who the counterparties in private credit are when they raise their hand and say, "We've officially realized losses on loans made to entities in private credit." And that's exactly what happened recently with a few US regional banks. They revealed losses related to private credit. And this had everyone asking, how many more of these loans are there out there? Is it safe to lend money to private credit? And most importantly, if this gets worse, will my bank or pension fund get negatively affected? Should I take my money out? And that's exactly how a financial crisis begins. Trust is shaken and money stops flowing. And this ties into something that every video we've seen about private credit seems to have overlooked. And that's who's been on the receiving end of these private credit loans. Who are the borrowers? Now, to recap, the lenders have mostly been large private credit companies who either lend using their own money, using the bank's money, or just issuing the loan and selling it down the line to someone else for a profit. The answer can be found in the explanation of private credit I gave earlier, specifically the part about how banks have been restricted from lending to high-risk clients. Logically, the primary borrowers of private credit are individuals and institutions which are considered too high risk for banks to lend to. And this begs the question, who exactly falls into this cohort? Financial regulations post-2008 have the answer. Small and medium-sized businesses lacking strong fundamentals, large companies that are highly speculative and barely profitable, real estate sectors considered higher risk like certain types of commercial real estate, and individuals with low credit scores. In terms of industries, technology, real estate, and healthcare appear to be the largest recipients of private credit loans, but it's hard to know for sure. In any case, the key takeaway is that private credit is involved in lending to the real economy, and this is yet another subtle dynamic that doesn't get discussed enough because it means that issues in the real economy can create issues in private credit, which can turn to create issues for the financial system. And the recent collapse of Tricolor Holdings is a perfect example here, especially because it's a real one. To bring you up to speed, Tricolor Holdings was a used car retailer that also issued auto loans. Tricolor Holdings was known for giving auto loans to undocumented immigrants in the US, with almost 70% of all of its loans reportedly being given to such borrowers. As you might have heard, the current US administration has been cracking down on undocumented immigration. Lo and behold, suddenly Tricolor Holdings was sitting on a bunch of risky auto loans, with the borrowers nowhere to be found. And it went belly up. Now, to be clear, the details of the bankruptcy are more nuanced than that, but again, the key takeaway is that the real economy can impact private credit. And again, that's because private credit has been increasingly involved in lending to the real economy since 2009. And this underscores the negative feedback loop I explained earlier. Even small issues in private credit can cause lenders to pull back, and if the borrowers are economically active individuals and institutions who desperately need these loans, the economy starts to suffer when they can't get them. And this economic hardship results in even stricter lending standards, both inside and outside of private credit, and so on. For reference, about half of the US GDP comes from small and medium-sized business activity, and just under half of those borrow from regional banks, which, I'll remind you, also tend to lend to players in private credit. So, issues in private credit mean that small and medium-sized businesses get squeezed directly by a lack of new private credit, and indirectly by stricter bank lending. And that reminds me, by now you're probably wondering what happens with the loans that private equity firms issue and then sell to other financial institutions like pension funds. Thankfully, the data suggests that only a small fraction of private credit loans have been passed on and sold to other financial institutions, with many sources suggesting the total amount is less than 100 billion, so not that much in the grand scheme of things. Even so, headlines that financial institutions like hedge funds have taken losses on private credit loans can cause all those questions to start bubbling to the surface. You also can't help but raise an eyebrow when, say, PayPal announces that it sold $7 billion of its buy now, pay later loans to Blue Owl Capital, a private equity company whose shares have been totally collapsing since the start of the year, like all others. And if you want to take advantage of all the volatility in stocks given the private credit collapse, check out the Coinbase Deals page. Over here, we have numerous finance-related deals and bonuses exclusively sourced for viewers of this channel. To check that out, scan the QR code over here or hit the link in the description. Now, these deals won't be around forever, so take advantage of them ASAP using the QR code here or the link in the description. Back to the video. Now, all of this relates to the recent events in private credit and whether they could be a prelude to the next global financial crisis. And let's start with a quick rundown of recent events. When the issues in private credit started isn't immediately clear. Some believe they began the moment the Fed started raising interest rates in 2022, as higher yields on bonds made private credit loans less appealing to investors looking for yields. What is clear is that it wasn't until April this year that cracks in private credit started getting noticed, and that's when Bloomberg published an article with some sobering statistics. 40% of private credit loans are struggling, compared to 25% in 2021, and banks have exposure to over $500 billion of these loans. And there was almost no reaction, though, which was not surprising. I mean, everything was crashing after Liberation Day. Fast forward to the summer, specifically July, when Forbes warned that the cracks in private credit were turning into fractures. Then, in August, Trump signed an executive order allowing 401k retirement plans to invest in alternative assets, with an apparent focus on private credit. A few pointed out that this was essentially the US administration's way of trying to plug a growing hole, but not many people listened to that. Then came September, when the breakages began. Tricolor Holdings and First Brands both went bankrupt, and in case you forgot, Tricolor Holdings was intertwined with private credit, as was First Brands. After multiple regional banks confirmed exposure to these and other delinquent entities in private credit in their Q3 earnings in October, everyone started paying attention, and the markets started collapsing. Right now, the official narrative is that issues in private credit are small and contained, so there's nothing to worry about. And anyone who's been in the markets since 2007 will know that this is exactly what the official narrative was back then, and they'll know that the sequence of events is eerily similar. For months, if not years, people had been warning about subprime mortgages, but almost nobody noticed. Then, in July 2007, two hedge funds heavily involved in subprime mortgages went under. The collective size of these hedge funds was objectively small, just a couple of $1 billion, but it was enough to cause entities in the subprime mortgage market to lose confidence and trust. By August 2007, the Fed had started to intervene with rate cuts and stimulus to stabilize both the mortgage market and the falling stock market. The Fed's intervention triggered one final blow-off top into early October 2007, when the market started falling again on the news that bank exposure to subprime mortgages was bigger than expected. In the months that followed, things got worse, and the rest, well, it's history. It's easy to see the parallels between subprime mortgages in 2007 and private credit today, even when it comes to catalysts. Back then, the subprime mortgage market was complex and opaque, just like private credit is today. Back then, two hedge funds involved in subprime mortgages went under, just like two companies involved in private credit went under recently. And back then, banks started realizing their exposure to subprime mortgages was bigger than expected, just like banks are starting to do the same today with private credit. The only difference for now is that the Fed hasn't staged an emergency intervention. Still, it probably wasn't a coincidence that Jerome Powell announced the Fed would soon be ending its QT program right when concerns around private credit started rising. For those unfamiliar, emergency intervention by the Fed is seen as bearish. So the Fed could be trying to be discreet in addressing this emerging crisis. And this brings me to the big question. And that's how we can know if issues in private credit will evolve into the next global financial crisis. And the answer might surprise you, and that's to look at the stocks of the largest entities involved in private credit. And that's simply because if issues in private credit start to evolve into something more serious, the first place you'll see that stress will be in the prices of these related shares. To refresh your memory, these companies are Apollo Global Management, Blackstone, Ares Management, and KKR, all of whom are publicly traded. As you might have noticed, all of their stocks are looking bearish. In fact, they've been looking bearish since December 2024, which suggests that's when private credit started experiencing stress. Regardless, long-term bearish price action is a bad sign. But wait, it gets worse. If you compare the charts of these 5 private credit companies to the charts of Bear Stearns and Lehman Brothers, you'll notice they look almost identical. For those unfamiliar, Bear Stearns and Lehman Brothers were two investment banks heavily involved in subprime mortgages. Their collapse in 2008 officially kickstarted the crisis. The good news is that if we are in the early innings of the next financial crisis, this means that we're likely somewhere in the summer 2007 stage, with September 2025 potentially being analogous to July 2007. And if this is the case, then what comes next should be some unexpected easing from the Fed that triggers a final blow-off top in markets that lasts sometime until later this year, maybe early next year. History suggests that the extent of the issues within private credit will only be revealed in the next round of bank earnings in January 2026. And that's when more banks will reveal how exposed they are to private credit in their Q4 2025 earnings, and when the markets will react the most. The crisis itself may not be evident until some of these large private credit players go under, possibly later in 2026. But until any of that happens, remember this quote from former Citibank CEO Chuck Prince in July 2007, quote, "When the music stops in terms of liquidity, things will be complicated. But as long as the music is playing, you've got to get up and dance. We're still dancing." And that, ladies and gentlemen, is exactly how it's going to go. Everyone will keep dancing until the music stops. So, keep your eyes on the exits. But before you exit, be sure to smash that like button if you enjoyed this video and subscribe to the channel and ping that notification bell so you don't miss the next one. Thank you so much for watching. This is Nick, signing off.